In the last 90 days, over $3.2 trillion has quietly moved across global markets. Not because of innovation, not because of growth, but because the world is getting uncomfortable again. Wars don't just destroy countries, they silently rearrange money. And if you think this is just headlines, you're already a step behind. 2026 is not a crisis year, it's a pressure cooker year. Multiple conflicts, trade tensions, sanctions, and supply disruptions are all building at the same time. And here's the part most people miss. Money doesn't panic, it relocates. Right now, global investors are shifting nearly $500 to $700 billion every single month into safer assets. That's roughly the size of an entire economy moving every 30 days. So the real question is, where is this money going? Let's follow it. Gold has surged close to 20% year on year, with central banks buying over 1,000 tons. Countries like China and India are steadily increasing their reserves. At the same time, the US dollar continues to dominate around 58% of global reserves, and during geopolitical tension, demand for dollars rises almost instantly. Government bonds are also attracting massive inflows. Even with returns around 3 to 4%, investors are prioritizing stability over higher returns. Now look at the other side. Emerging markets have seen capital outflows of nearly $200 to $300 billion in recent quarters. Investors are pulling money out during peak uncertainty phases and waiting on the sidelines. Even strong companies are not immune. Tesla has seen stock swings of over 12% within weeks, not because of its fundamentals, but due to changing global sentiment. Similarly, Nvidia Corporation, despite strong growth, has experienced volatility spikes during geopolitical escalations. This tells us something important. In uncertain times, even the strongest players get pulled into broader market movements. Crypto markets reflect this even more sharply. Bitcoin has shown swings of 15 to 25% during periods of global tension, behaving more like a risk asset than a safe haven. Now let's go deeper. War doesn't just affect borders, it disrupts supply chains. And supply chains affect everything. Oil is the clearest example. Even minor disruptions can push crude prices up by $10 to $15 per barrel. When that happens, companies like ExxonMobil and Saudi Aramco see strong revenue gains. In recent cycles, energy companies have reported profit increases of 15 to 25% during instability. But the impact doesn't stop there. Every $10 increase in oil prices adds roughly 0.3 to 0.5% inflation globally. In a $100 trillion economy, that translates to a $300 to $500 billion impact. And that cost flows through the system. Fuel becomes expensive. Transportation costs rise, food prices increase. Global food indices have historically jumped around 20% during conflict-driven disruptions. At the same time, semiconductor supply chains tighten. Companies like Taiwan Semiconductor Manufacturing Company become critical because even small disruptions there can impact trillions of dollars worth of global production. Ultimately, these costs are absorbed by consumers through higher prices, higher EMIs, and reduced purchasing power. Now comes the next layer, central banks. Institutions like the Federal Reserve and the European Central Bank respond to rising inflation by increasing interest rates. Currently, many major economies are operating in the 4 to 6% range. Higher interest rates make borrowing more expensive. Companies delay expansion, consumers reduce spending, and housing demand slows. As a result, economic growth weakens. Globally, globalistic instability can reduce GDP growth by 0.5 to 1.5% annually. In absolute terms, that's a slowdown of up to $1.5 trillion in output. So if we connect everything, war leads to supply disruptions. Supply disruptions lead to inflation. Inflation leads to rate hikes. Rate hikes slow down growth, and slower growth increases market volatility. And throughout all of this, money keeps rotating. Now the important question, who benefits? Defense companies are among the biggest gainers. Firms like Lockheed Martin and Raytheon Technologies have seen strong order inflows, with global defense spending crossing $2.5 trillion annually. At the same time, retail investors often react emotionally. And this leads to one of the most important insights. Markets do not move only on reality, they move on expectations. Even a rumor of escalation can wipe out $1 trillion in market value within days. We've seen markets fall 3 to 5% in a single session based purely on headlines. That's trillions of dollars moving, driven by perception. And investor behavior tends to follow a pattern. Fear leads to selling, panic leads to more selling, stability leads to buying, often at higher prices. This is why many investors end up selling low and buying high during uncertain periods. So what does this mean for you? First, volatility is not the problem. Lack of understanding is. When you understand why money is moving, you stop reacting emotionally. Second, money is not disappearing. It is shifting. From risky assets to safer ones, from growth to stability. If you can track that shift, you are already ahead of most participants in the market. Third, every geopolitical crisis creates two phases: short-term fear and long-term opportunity. Historically, markets that decline during crises often recover strongly, delivering returns of 30 to 80% in the following cycles, but only for those who stay invested and understand the cycle. So, the next time you hear about war or global tension, don't just focus on the surface. Instead, ask a more useful question. Where is the money going right now? Because if you can answer that, you are no longer just observing the market, you are beginning to understand it. This is FinSpread, where we don't just follow money, we decode it. And this shift, it's far from over.